It's Wednesday the 20th. Good morning. OK, this is what's going on. UK inflation is dropping right now. Bond yields are basically stabilising. And Samsung workers say they are striking, possibly tomorrow. We'll see, Anna.
Yeah, absolutely. It's having an impact on the Kospi then, Guy. And this is the picture coming through to us from Asia. Weakness in the Kospi, down by 1.3%. We continue to, we worry about the job story there out of Samsung. We continue to think about AI. It's Nvidia day, so we'll certainly keep technology front and centre. That has an awkward read across usually into the European session. But European stock futures are showing a weakness at the start of the European trading day. We're light on the earnings stories here in Europe. We don't have an oil price going higher. And the US didn't do much after, well, it went up and then down again after we closed. So interesting to see whether we get that futures picture come to pass. Brent crude then is down by 0.5%. Are we showing a reduced reaction function to what we hear from the White House with regards to threats in the Middle East? The countdown to the opening trade starts right now.
Let's bring you the breaking lines when it comes to the UK inflation story, and it is a more benign picture than maybe some had feared. 2.8%. That is the number for the month of April. Year-on-year CPI coming below the survey number of 3% and below the previous print of 3.3%. So inflation coming in a little lower than the expectations, 2.8% year-on-year. Core CPI also a little softer as well, 2.5% on a core level, just marginally softer than the surveys of 2.6%. In terms of services, we've seen that has been stickier. 3.2% was the number on services versus the print of 3.5%. Again, this is a slightly more benign picture in terms of the inflation print out of the UK for April. We'll see how the trading price is, because you've seen about a 20% chance that the BOE would go in June. We'll see if that adjusts on the back of this. The pound is a hike in June. The pound is a little softer on the back of this data.
Enjoy it while it lasts, I think probably is the take here.
That's the message from Bloomberg Economics, isn't it? They were suggesting that this would be driven by some of the things that we can foresee to do with controlled pricing around energy. But looking ahead, they expect inflation to accelerate in the coming months, peaking just shy of 3.5% around the turn of the year. So that's a different conversation. Yesterday, it's interesting, though, if we do have this slightly more benign picture on inflation, even if it's temporary, sitting alongside a weaker jobs market story from yesterday, does it start to materially reprice how many hikes the market is expecting from the Bank of England?
The government, the story this morning around the UK is not actually about what is happening with the inflation numbers, because, as Anna says, a lot of this is kind of mechanical. The story is the fact that the government wants to control grocery prices. It already controls energy prices in a big way. Does it now want to control grocery prices? This is the story. Maybe Rachel Reeves eases up on the packaging restrictions but says you have to keep egg prices under control.
So that seems to be the quid pro quo. This is voluntary, is what we're hearing. And Rachel Reeves has been in conversation with the supermarkets, with the grocers, about maybe capping food prices in exchange for some regulatory easing, to your point. But there has been a fierce reaction from the industry who've pointed to the 1970s
is this where we're
as an
at?
example.
Is this where we've got to?
Well, it's certainly leaving some people speechless. The ex-boss of the IFS, the Institute for Fiscal Studies, Paul Johnson, saying he's lost, this is on X this morning, saying he's lost for words. He never thought he'd see the government trying to control food prices. And pointing out something that the food retailers point out when these kinds of conversations come up, as they periodically do, not with this kind of level of threat of intervention or even voluntary intervention. This is a highly competitive industry where margins are actually, compared to lots of other industries, margins are pretty low. But
what are you talking? Margins are 6-7% for grocers. They are incredibly slim. And to your point, it's a highly competitive market here.
So what does this mean for farmers? What does this mean as you go down through the food chain? What happens? Farmers are already pretty stressed anyway. As you work your way down through the food chain, what happens? Because they're already under pressure from a bunch of other factors. This could be the latest blow. To the 70s kind of analogue is really interesting. Are we getting to the point where basically the Bank of England, you could assume, if the government is having to do this, does this imply that the Bank of England has lost control of the inflation narrative? There is an argument that kind of points you in that direction.
And the government has been trying to do these quite direct interventions in pricing in areas where they can, like regulated energy prices. They've been trying to take the steps that they can, I suppose. And I guess that by the local election results increasingly put the focus on the cost of living. So that's the politics behind all of this. 50 years since 1976. We'll just say that. Is that the right maths? Let's talk about the bond markets. We have the JGB long end in focus, and it's been in focus for many months even, but particularly over the last few weeks it's been in focus. But actually we see the long-end yield coming down today, and it does prompt the question, with all of this selling in bond markets, are we going to see some people coming in and deciding to buy? PIMCO talking about JGBs at the 30-year, saying the curve is too steep and that represents a buying opportunity. Will there be others who are similarly minded, or are we, or is that just a sort of outlying view? Interesting that there's quite a lot of evidence that foreigners who have been playing an increasingly large role in the JGB market have actually been selling recently, and that just underscores, I suppose, the fragility that this bond market now has, which is something we used to say about the UK and others.
Yep. Bond markets feel fragile pretty much everywhere. US is running a massive deficit. That's a significant problem. Do you buy now? Do you average in now? Do you, if you're going to buy, if this is a buying opportunity, are there better buying opportunities still to come? We were talking to guests yesterday who were saying on this show that they think the yields could go significantly higher from here, and there are plenty of people pointing out that could happen as well. How much further, how much higher could we go? What is interesting is that actually, if you look at corporate spreads, they're still very tight. If you look at private and corporate balance sheets, they're still very strong. You were pointing out an article. How much of a read across is there into stocks, but also from government bonds into the credit markets, into stock markets and other areas?
So we have a chart that shows financial conditions. It's the Bloomberg Financial Conditions Index, FCON, which actually shows that financial conditions are quite loose. It actually shows that the VIX is in its teens, not in the kind of 30s or 40s that you might expect at times of great volatility, or even 70s when you're thinking back to the great financial crisis, or, of course, the global financial crisis, or, of course, COVID. So financial conditions remain relatively loose still, despite the sell-off and despite the fact that the 30-year stateside is now at their highest level in terms of the yield since 2007.
And the Markets Live blog pointing out that the reason for this is that, yes, we've seen a lot of movement at the long end of these global bond markets, but a lot of it's been focused at that long end, and it hasn't necessarily, therefore, had the read across into other measures of volatility. And so maybe mortgage markets, maybe corporate balance sheets managed to brush this off, at least for now. But I mean,
I think for now is the kind of critical.
It all counts, doesn't it, in the end? But maybe they brush it off for now.
Let's talk about tech. Samsung. So talks are broken down between unions and the company. This was a mediated set of talks. The company apparently walked away from the talks after the union had accepted the latest mediated offer. What happens now remains to be seen. Is this a bargaining chip by the unions? Will they actually deliver on this strike? This would be a huge hit to a global supply chain that is already being pushed fairly hard right now. Will the government step in? It did so with Korean pilots back in 2005 and has done in the past to force basically a strike not to happen or a strike to end. But this at a time when we're already worrying about the availability of chips and the inflation rate that comes within the chip sector, this would be a huge blow.
Whether or not this comes to pass, this is a reminder of the pressures and the tensions that we can imagine are going to percolate through the system into the future as well. And so, yes, come Thursday, it's possible they come to a resolution. But SK Hynix has raised the bonus pool, and Samsung employees are saying, we want a piece of this. We can imagine that as you see the profits accumulating to a smaller group of people and a smaller group of companies, these kind of fictions will come to bear, not just in South Korea. So there's a bigger takeaway from this, potentially. And, of course, the supply chain impacts from this, given that pricing is projected to run up even higher into 2027, particularly when it comes to high bandwidth memory.
Yeah, there's a few people pointing the finger or focusing on the fact that there are, if we're going to be in a world of fewer jobs, then those people who have them might have outsized leverage on what happens. So it's something to watch across the sector. Should we think about Nvidia? We've got Claire Pleydell-Bouverie coming up, who's big fan of Nvidia, and I was just reading her notes earlier on. I mean, she's just I lost track of the reasons she's positive. There are just so many reasons why she's positive. But also our colleague Dan Curtis pointing out that actually if you look at the PE multiples on Nvidia going into the numbers, it's on 23 forward PE, which is actually quite low compared to other earnings days. So we don't often see it this cheap, quote unquote. Can't believe you say that word in this context, but it's not usually on that measure this cheap on earnings days.
Lots of competition coming. That's a huge issue. What's going to happen in terms of the build-out? That's a huge issue. There's are Samsung and TSMC and SK Hynix, are they better, cleaner plays on actually the deliverables of the AI build-out? Because maybe they're more of a reliable story, despite maybe what we're saying with the strike.
And that's a test of how well Nvidia has locked down the supply chain as well. So that is another potential test. With sales expected, sales estimates have grown 80% in the first quarter. Again, those earnings dropping after the market later today.
Be interesting to see what the shares do. They haven't done well.
They've underperformed the sector.
Yeah, they continue. Amazing to see. Raffario Cristieri, RBC Wealth Management fixed income head for UK and Europe, is going to be joining us very shortly. We'll talk about what is happening in this fixed income story. Very late, Latitude Investment Management managing partner joining us, I think at around 8 o'clock. Mark Gianni, Barclays chief US economist, and Pleydell-Bouverie, Lions Trust fund manager, joining us a little bit later on too.
OK, here's what else we are watching throughout this Wednesday. The nominee for Bank of France, Governor Emmanuel Moulin, appears before the Senate Finance Committee at 8 a.m. UK time, so we'll watch for any potential lines on that. The Italian Prime Minister, Giorgia Meloni, of course, will be meeting with her Indian counterpart, Narendra Modi, in Rome. And Russia's President Vladimir Putin is in Beijing. He's already met with Xi Jinping and has received some of the pomp surrounding that visit as well. 7 p.m. UK time, Fed minutes from the latest meeting, and at 9:20 p.m. UK time. So that's the marker for your calendar today. 9:20 p.m. is the Nvidia earnings story and the details from that.
Probably quite cost effective if you're going to welcome one world leader.
Just dust off.
Just dust off the same carpet and everything.
A few days later.
I imagine the sort of turnaround costs are lower if you do it just days later. But interesting, some of our colleagues pointing to some of the lines coming from China's Xi, calling for a more just and reasonable governance system, and some suggesting that this is a kind of dig at the United States, I suppose. Do you feel with these summits that sometimes it takes a little bit of translation afterwards, and sometimes a bit of time, because some of the news lines come out on the day? Certainly the pomp and the ceremony is evident on the day, and the bonhomie is evident on the day, but what this really means for global geopolitics sometimes takes a little while to materialise.
I mean, particularly when you have two regimes that are less transparent in terms of their communication. So we'll see what comes of. For the Russians, it's really important to get the Chinese to sign off on this Siberian pipeline, power pipeline number 2. And they've wrestled. The Chinese have been driving a hard bargain on this. And so the view from Moscow may be that they're in a better position right now, given the energy challenges that China faces, to finally lock that deal in.
Yeah, I think that would be huge if that were to happen, and would again change the arithmetic for Russia and the way it looks at its economy, which is stressed at the moment. What else do you need to know this, Wednesday morning? The US military says it will permanently remove around 4,000 troops from European soil. A Pentagon spokesman says the move is aimed at pushing NATO allies to, quote, take primary responsibility for Europe's conventional defence. The number of US Army brigades, combat teams stationed on the continent will drop from 4 to 3. The Army brigades constitute a share of the 85,000 American troops that are currently stationed in Europe. And after months of negotiations, the European Union has finally agreed to the text of its long-awaited trade deal with the United States. Under the agreement, the EU will remove levies on US industrial goods in return for a 50% ceiling on tariffs. The European Parliament and the EU countries will have to vote to ratify the finished text. Trump has threatened, remember, to hike tariffs on European automobiles, cars, if the deal isn't in place by the 4th of July. So I'm going to stop now because you're going to read this next one.
I think this is important. This should have been top of our agenda, really, arguably. We had that debate, didn't we, during the editorial meeting? Yes,
you've got to wear that and read. You've got to read it,
Arsenal
wear it.
Winning. You may notice the tie choice as well. I'll be careful of this, of course. 22 years we've waited for this.
Yeah.
Finally clinching the Premiership, of course.
Because Bournemouth.
Thank you to Bournemouth, of course, with that draw versus Man City last night.
So Arsenal will be handed the
trophy. I was getting a lot of alerts on my phone. I was very disciplined.
In the back of those pictures. Were you there, Tom? Is that you at the back
right next to the Emirates, of course, in Islington. 22 years. I was there in Islington when, of course, Arsenal won in 2004.
I lived there as well. I lived in
Thierry Henry, Patrick Vieira, Arsene Wenger, of course.
Down Upper Street.
They did the parade on the bus. We'll see what Islington Council does for this time. And, of course, Crystal Palace is who they play at the weekend. And they'll be handed the trophy, whatever the result.
But you're not done yet, are you?
May the 30th, PSG. Paris Saint-Germain.
Are you going to wear the scarf until then?
That's the agreement, isn't it?
He's
got to wear it for the rest of the show now.
We'll warn the stylist. I can confirm that North London was noisy on the back of this yesterday. Coming up on the programme then, a crucial test for the AI boom today, with Nvidia set to report its earnings. We will discuss what to expect from the $5.3 trillion company. Plus, we will look at the stocks to watch, including Marks & Spencer, the UK retailers putting out its its full-year results, and full-year adjusted profit beat estimates this morning. A lot to think about, though, when it comes to food pricing this morning. Up next, we will be joined by Stéphane Boujnah, who's the CEO of Euronext, for an exclusive conversation. If you want to get involved in any of these chats we're having around the desk, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Good morning, welcome back. 42 minutes until the start of trading here in Europe. At the moment, you're looking at a picture that shows Europe is actually expected to open lower. But if you look on the other side of the Atlantic at what is happening in the States, US futures are a touch higher. The Nasdaq's a little higher than the S&P, but they are both in the green. The volatility basically continues, and that takes us on to our next conversation. Euronext, overnight, beating estimates in the first quarter. Volatility, boosting trading volumes. Joining us now for an exclusive conversation, Stéphane Boujnah, the CEO of Euronext. Stéphane, always a pleasure. Thank you for your time this morning. So the volatility helped. Does it continue? Is that what we should expect?
Well, the beginning of the year has been very dynamic. The volatility is very high. We are seeing, for the first part of Q2, a continuum momentum on volatility. But again, we are posting the 8th quarter of double-digit growth for Euronext. And when you post double-digit growth for the 8th times, i.e. for 2 years, it's not a phase, it's not a moment of volatility. There is much more than volatility behind those great numbers. There is a profound transformation of the business, which is now much more diversified than just capturing volatility. So we are very happy and fortunate to benefit, like all the market players, of the volatility of the beginning of the year. But in addition to that volatility, there's a profound transformation of the business, which is much more diversified than it has ever been.
And would survive a drop in that volatility, I guess, is the implication of what you're saying. Talking of diversification, at the beginning of the year, we were talking about a diversification trade into Europe, that people were looking to exit the United States. They were looking to widen their lens and add European stocks. Since then, though, Stéphane, we've seen US stocks taking off again. The tech trade has been a big part of that. And Asia has delivered some pretty substantial upside as well. Does Europe feel like it's being left behind?
I don't think so. I mean, what we see for real, in particular since the revived tensions in the Middle East, is a continuous but consistent and slow inflow of Asian money and US money into Europe. There is no debate about that through all sorts of pipes. So Europe is still perceived as a safe place in terms of risk-reward profile. Now, if the tension in the Middle East do continue, it's clear that the impact on the energy market is going to be much less painful for the European continent, which is less dependent of carbons, of hydrocarbons than Asia. So we are seeing in our conversations with asset managers revived flow of money from the rest of the world towards Europe.
Stéphane, good morning. Can I ask you about IPOs and the flow of IPOs coming to market? Are we seeing something of a step change, a gradual shift? How would you characterise the moves we're seeing now? And how resilient is the higher level of IPOs to the big IPOs we're going to see coming in the United States a little bit later on this year from the tech space, from the AI universe?
Yeah, we are seeing in Europe a significant momentum on aerospace and defense IPOs. We had the largest IPO ever in aerospace and defense with a Czech company listed on Euronext at the beginning of the year for around 30 billion euro market cap. And we are seeing a lot of aerospace and defense companies looking at market just because aerospace and defense is the current sweet spot of IPO. Those companies do need to raise equity to fund incremental capacities to manufacture more and more quickly and to deliver speed and scale. Those companies have great valuations, and those companies do need paper to consolidate the sector. So when you need paper to consolidate the sector, when you need own funds to finance incremental capacities, and when you have high valuations that are providing a good exit for existing shareholders, that's a sweet spot of IPO. And we are seeing an increasing momentum in this sector. We had Kongsberg Maritime being listed in the sector. We had Colt. We are going to have soon KNDS, the Franco-German land armored vehicles company. So the momentum is there, but mainly for the moment on aerospace and defense for the reasons I've just articulated.
OK, so not much overlap then with the AI listings in the States. Perhaps that's an advantage. Stéphane, thinking about AI, Mythos has attracted a lot of attention from Anthropic. Are you worried about it? Are you looking to get your hands on it, to test it, to see what it could do to your world?
Yeah, we are spending a lot of time and effort. We are not We are not born to be worried. We are born to take action, and we are taking action as much as we can. So the fundamental feature of this situation is that there is a sort of closed group, caucus of U.S. companies only that are processing the fundamental underlying developments. So we need to adjust to a situation where a part of the problem is not known to us. So we take action through all sorts of work streams. One of them is to develop partnerships and alliances and dialogues with other people like us that could be affected by these type of developments but are not part of the privileged group of US companies that are insiders to the situation. But we are definitely working on it. The more you work on it, the more you find out that the situation is evolving extremely quickly and that other players, more discreet in the planet, have developed or are developing solutions that could be fit for the future. So the specificity of AI is that you don't stay forever an incumbent, and the volatility in terms of release of new features, of new technologies is very dynamic, is very fast, and that's what we are trying to capture in our approach of the Mythos crisis.
Stéphane, I just want to take it back to your comments around the IPO pipeline. You talked about KNDS. Can you confirm that IPO is on track? Can you give us more details in terms of the time frame for the KNDS IPO?
No, as a matter of principle, I just comment what the companies are making public themselves. So KNDS has made clear their intent to go public this year. They clearly have to complete some restructuring on the German side, but the plan is to go public this year, whenever they are ready on the German side, and everyone is preparing an IPO for this summer, unless things are postponed. But clearly there is an ambition of this company to go public, precisely to address the points I've made: high valuation in the sector, which provide a good opportunity for the shareholders, a need to increase capacities to deliver speed and scale as quickly as possible, and an ambition to consolidate the sector with paper.
Okay. Stéphane, thank you very much indeed. Always appreciate your time.
You're welcome.
On the back of that earnings then, Stéphane Boujnah, Euronext CEO, talking about the pipeline around IPOs in the defence space when it comes to Europe. And then, of course, when we think about the US, SpaceX, potentially that $2 trillion IPO, we may get more details and an official marker on that later this week. But we're hearing that Goldman Sachs is leading the charge, according to the reporting at least, is named as one of the key underwriters of this IPO.
These are massive IPOs that are about to be delivered, and you wonder whether this is the kind of turning point for markets. They've been waiting for this, that it needs to be delivered upon. These IPOs have to get away. It's not just SpaceX, it's OpenAI, it's potentially Anthropic. Yeah. These are massive amounts of paper arriving into the market.
And it's quite soon, isn't it? So if we get, as soon as today, as you say, we'll hear a bit more, maybe, you know, about what is going on with Musk and Co. and SpaceX. They could list as early as June the 12th. So this is not very far off we're talking about here. And if we're going to see funds around the world having to adjust tech allocations, you know, do they want to take a step up in tech allocation on the back of this, or do they want to reduce other tech allocation to make space for this? That's going to be something we definitely need to watch.
On current reporting, OpenAI, Anthropic, SpaceX potentially combined $4 trillion going public.
What is interesting as well is that companies are not doing buybacks as much in this space as well. So you've got both of these two factors coming into play at the moment.
Yes, higher yields is going to be a focus for us in our next conversation as yields on the US Treasury's longest dated bond rise to the highest level in almost 2 decades. We will talk to Rufaro Kiriseri from RBC. This is Big Mac.
Half an hour to go until the start of cash trading here in Europe. The futures picture is a negative one on our side of the Atlantic. It is, as you can see, a little soft, not by much, down by 0.3%, pretty much across the piece this morning. We are, though, looking at a more positive picture stateside. Nasdaq minis are up by 0.3, S&P's up by 0.1, 0.2, if I'm being generous this morning. But basically, we're down a little bit here, we're up a bit there. That's my sophisticated take on the market this morning.
That's excellent. We are down a bit when it comes to yields across Europe, which is nice because it goes in the face of the dominant narrative recently, which has all been about higher yields, of course. But today we're down 1, 2, 3 basis points at the 10-year horizon across the European government bond space, and some of that coming through from Japan. So at the very longer end, we've seen some of those yields coming down in Japan. So maybe we're pausing for breath on the bond trade a little bit.
We'll get a take on whether or not we are pausing and where we go in this journey. But to your point, over the week, of course, the sell-off in longer maturity government bonds has pushed up yields to levels last seen during the global financial crisis. Let's bring in then, for further analysis, Rafaro Kirisiri, Head of Fixed Income UK and Europe at RBC Wealth Management, joining us now. Rafaro, thank you for your time this Wednesday morning. Where are we in this sell-off then? This reprieve that we're seeing in the markets, the bond markets this morning, is it going to be short-lived?
I think it's going to, it's not necessarily going to be sort of yields stay where they are for now. I think what we've seen in the past week is a bit of an unwind of some sort of crowded short positions that we've seen in the market. Then, of course, we've seen real yields also track higher. So it's starting to feed into that sort of fiscal story once again. And especially for the US, where that's largely been ignored sort of throughout 2025, that's now starting to come to the fore. And then when we look at other dynamics, say in the UK, for example, that political risk was starting to surface. That started to fade a little bit. But that inflation story continues to pretty much be feeding into what's happening in bond markets at the moment. It certainly does look a lot more interesting for bond investors to start to look at, especially at the US, where it's sort of been lagging other markets like the UK and Europe. But we're okay to be patient at the moment.
OK. In terms of what you're interested in, is that the long end of the US Treasury curve? Is it the 30-year at 5.18, that close to 5.2, that's starting to look attractive? At what level do you want to be buying at the long end, if it is the long end that you're looking at?
So we've actually been underweight the long end for some time, and it's really due to the fact around some of these fiscal concerns, as we sort of felt that yields were still a bit too suppressed given some of the size of the deficit, as well as we've got the Fed that is essentially on hold, and we're starting to see that some of that was not really priced into the curve. So we're actually happy to be sort of on the shorter end. But at the same time, it starts to look a lot more interesting with 30-year real yields at levels that we haven't seen since the GFC. So certainly an area that we're continue to watch out for.
Is the market overpricing the Bank of England when it comes to hikes?
We would say so.
Yep.
So our view is that given policies already in restrictive territory at 375, we also have a labour market that is weaker than it was in 2022. And even when we look at the decision maker panel sort of survey from April, we have businesses expecting that wages will be lower, a touch lower in a year's time. Also employment as well to be a touch lower. So we continue to see that weakness in the labour market feeding into the Bank of England, perhaps not hiking rates as aggressively as what's currently priced into the markets.
Is there a case to be made for the Bank of England stopping doing QE and actively selling bonds into the market, which is, it's hard to quantify, but lifting yields, it's pretty obvious that there is a yield lift effect of this?
So QT has been has sort of been running in the background for some time, and the Bank of England did acknowledge that it does lift yields a little bit. We necessarily haven't seen sort of a disorderly move in gilts because of that QT aspect. I think the big move at the moment is really that inflation picture, and then a little bit of politics on top of that.
Do you think it's happy with higher yields? Like in some ways that does the work of raising rates in terms of its impact on the real economy. I guess we're seeing this as a bug. Maybe it's a feature.
In terms of QT or just relatively?
Just keeping yields up. So it's a way of slowing the economy down.
I think ultimately the Bank of England, there's really no reason for them to be any more dovish than what's currently priced into the market. And we did hear from Bailey sort of stating that where the market is sort of about right. And so they can continue to talk a bit more hawkishly, but they don't necessarily need to follow through with the policy. Financial conditions have already tightened, so the job's sort of partly done already.
Just one more on the BOE then. Traders cutting their bets on Bank of England rate hikes today. We've had the CPI data, of course, came in a little lighter, and the jobs data yesterday. They're now pricing 54 basis points through 2026. So that's gone from, 2.5 being priced in to 2 and a little bit. I mean, does that sound right to you now, or do you think the market is still expecting too much?
Our base case is actually for 1, and that's sort of to come through perhaps around July time. And also when we look at the BOE's own sort of scenarios that they sort of laid out in terms of that scenario B, where they see energy prices remaining somewhat elevated, they don't see second round effects being a big issue there, and that's through to Q2. So we were seeing that sort of 2.5, what seemed a bit excessive just for 2026 alone.
Can I talk about the United States? We talked at the top of the programme about how even despite the long end of the yield curve move, financial conditions in the US not necessarily looking all that disturbed by these developments. And part of that is, I guess, because inflation is being pushed higher by supply-side concerns around the Strait of Hormuz, but also by quote-unquote good things, by the fact that there's so much excitement and growth attached to the AI theme. How would you evaluate the things that are moving the long end of the curve and the things that are building that inflation dynamic in the States?
I think when we sort of look at, I suppose, the big reaction that we've seen in sort of the past week, I think firstly it was sort of some of that positioning where it was a bit of a crowded sort of short positioning. But then also when we look at it's that fiscal sort of element coming into play. Higher yields only worsens the deficit, so also that comes into play. Then when we look at funding for next year, likely that we have higher coupon issuance as well. That's likely feeding into where yields are. But we think ultimately, so a lot of these factors will continue to plague the long end of the curve. You have investors as well in terms of just the natural sort of less yield-sensitive investors not necessarily wanting to hold that longer-dated debt. So we think some of these dynamics are playing into the long end of the curve.
How are these dynamics playing into corporate credit? When does corporate credit potentially become vulnerable? There's been a lot of issuance. Spreads are obviously quite tight, historically tight. There's been a lot of issuance. When does the read across from the sell-off in the sovereign bond market potentially start to change the dynamics of corporate credit?
So as you rightly pointed out, we've had a lot of issuance this year. So far, in terms of the run-up, we're close to sort of levels that we last saw in 2020 in terms of issuance. But then more interestingly, within different sectors, the tech sector is now issuing debt at 4 times the pace of the average that they have in the past 4 years. So that's a big shift in terms of the index composition. But at the same time, within that sector, it's not all companies are the same. Some are coming from a base where they have a lot of cash on their balance sheets, and others, their fundamentals are not as good. And so the sort of competition for buyers in the market is there with credit, with a lot of issuance from credit, a lot of issuance from governments. And so effectively, we think the equilibrium needs to sit a bit higher. And we think credit spreads have tightened a bit too much, even though the tech sector spreads have widened a little bit just because of where issuance has been. But we think there's actually room for spreads to move a bit higher, just given the sort of the inflationary outlook, the real yields shifting higher, and of course all of these factors coming into play. We think yields and spreads need to be a bit higher.
The spread's widening, is that a small move? Or do they need to? Is there quite a big catch-up still with the govvie market?
We think there's still quite a bit of a move in credit spreads through the rest of the year. So we're happy to be somewhat underweight in credit. But we think there are still pockets where it is interesting. So we think this dynamic where you've got issuance, heavy issuance from some sectors and not others. We think financials will benefit from this dynamic just because of the issuance and the supply in that in that space. But then also, interestingly, we've seen a lot of US issuers issuing outside of the US, so in the European market and the sterling market.
Is that because the US market can't handle it? Or is the US market swamped now?
I think part of it is just because of where cross-currency, where it looked more attractive in terms of funding. So for some markets, UK, Swiss francs, euros, it looked a little bit more attractive for issuers to issue in those pockets. And for the sterling market, that was actually quite a significant uplift in terms of issuance coming outside of the US.
Rufaro, thank you very much indeed for coming onto the show. And with those insights, Rufaro Kiriseri, Head of Fixed Income UK and Europe, RBC Wealth Management. Let's get some lines right now because, of course, we've been talking about the fact that Vladimir Putin has been meeting his Chinese counterpart in Beijing. You can see there's a signing ceremony taking place right now. They appear to have signed a number of different agreements around energy. They have signed a declaration on a multipolar world. This is what both countries have been pushing for, both leaders have been pushing for. It's the energy piece that we've been focused on in particular, and Xi Jinping earlier calling for a resolution to the conflict in Iran. But some lines coming out on the back of this signing ceremony then in Beijing, guys.
Yes, and Xi and Putin witnessing the signing of documents on trade, on technology, on some and railways. So there were 20 of them, as you say, Tom. So a lot of different. We saw all of these documents being wheeled in, signed by various individuals, and then taken out again. They came in quick succession. President Xi is now talking and saying that talk with Putin has been on a range of major issues. So we'll wait for the details to emerge.
You'd hope so, wouldn't you? They don't just sort of come together to sort of chit-chat. Major issues.
Yes.
There's plenty of those to discuss right now. Talking of which, ECB policymakers say they may have to respond to the economic challenges arising from the Iran conflict.
This whole conflict started more or less 3 months ago. Now we know that this energy supply shock is more persistent. So we are moving away from our baseline scenario.
Moving away, Joachim Nagel, the ECB Governing Council member and, of course, Bundesbank president, speaking to Bloomberg at the G7 in Paris. We're going to have more on the growing global inflation concerns. This is Bloomberg.
This is the opening trade, Wednesday, the 20th of May, and the picture across European equity markets looks negative, down by around 0.4%. We're pairing those expected losses just a little bit. US futures actually flat to positive, so E-minis are flat. Nasdaq futures are positive, of course. Tech is a focus for us today, Guy. We have Nvidia earnings coming up later on today, and in the meantime, there's Samsung.
Yeah, I think Samsung's actually a more interesting story and could certainly have a much more devastating effect in terms of its impact on the global economy. Talks between the unions and Samsung have broken down. The union saying a strike or a work stoppage, I think as it's termed, is now planned for tomorrow. The two sides have not been able to come to an agreement over disputes over bonus payments, and the strike could now hit production, and therefore we get delays. What does this all mean? Neil Campling, Bloomberg's senior market strategist, joining us now. We live in a world where we're already short of these kinds of high bandwidth memory chips, and potentially this would really exacerbate that problem, which creates an even higher pricing regime that we could go into. The implications of this are what?
The implications are enormous if the production plants shut down.
Because they're quite hard to restart, aren't they?
This is the problem. The problem is to get a leading-edge fab back online can take up to 6 months.
OK, that's an issue.
So full production can take 6 months. These are really high-precision technologies, so you can't just, like, flick a switch.
Yeah.
So this is why you had backups and everything to allow for electrical supplies going down, those kind of things. So it's a big issue when, as you mentioned, there's a supply issue in the first instance because of the high demand. So this could exacerbate it. I suppose the question now is, do the government step in?
Yeah.
The answer to that is what?
The answer to that is I have no idea, but I did talk to some locals about 20 minutes ago, and they said, obviously, there is a potential, this is potentially bargaining tools, etc., but we are really at the 11th hour here now, and there is no sign yet of the government taking that step. So, it's a concern, and who knows? The knock-on effect could be in a few months' time that we get companies potentially warning they can't meet expectations because they can't get the chips. That is the risk.
Because that's the point. This is a potential global disruption story from this strike.
Well, Samsung is the biggest memory producer in the world. You know, there are three companies combined that own 90% market share. There's Samsung, Hynix, and Micron. So Hynix and Micron, you may think, well, they're already sold out capacity-wise. So they've got a problem as well. So it's not like they can go, oh, that's OK, more business for us, because they can't supply enough chips. Hynix have already told us they think that, they're sold out all of this year, all of next year. So it's not like you can swap one out for another. So it is, without doubt, a potential massive problem for the industry.
Thanks, Neil. Thanks for bringing us an update on Samsung. We'll keep watching those developments, of course, and we're running up to the Nvidia earnings. That'll keep tech very much in focus. Neil Campling with us to talk about what's happening on the tech space. And let us turn our attention to what's happening in broader markets. Today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, as we wait for Nvidia then, what is catching your eye in the global narrative? Are we pausing for breath on the higher yield story? Is that the message out of Japan and, again, here in Europe as well?
I think that the yields move is getting to those levels where this is getting close to the end for the now. I'm not quite sure it's over yet. I think what is interesting is that bond markets are suddenly, over the last week, the last 9 sessions, or 7 trading sessions, I should say, have priced in the Strait being closed for a substantial amount of time, but central banks being asleep at the wheel. And that's why we're seeing the long end in particular get hit. We're seeing that steepening. If they thought central banks were going to react to inflation, then we'd see more aggressive flattening. So that the bond markets are kind of pricing the Strait closed almost in isolation. We're not seeing it in other asset classes. The other thing out there is, just as you guys have been discussing with Neil Campling, is I think the Samsung story is potentially massive. We just outlined recently that Samsung and SK Hynix are 2 of the 5 most influential stocks on global portfolios at the moment, given their volatility and what that's having on other asset classes. Not 2 of the 5 largest in terms of market cap, 2 of the 5 largest in terms of impact on global portfolios. And I think because retail is driving the trade, they're kind of ignoring what's happening on the Samsung strike. And if the strike does go ahead, you've got a major problem on Korean stocks, which are really kind of the bellwether or the poster for AI retail enthusiasm. And I think that will have massive contagion effects. Never mind the secondary effects that Neil Campling was arguing about, the fact that we might have a shortage of memory chips later on. That's another problem. Just the immediate stock market impact will be quite large. So I think there's quite a bit going on at the moment, and I'm getting a little bit more nervous again.
What about what's happening in the Gulf? Getting nervous there?
Well, my base case assumption is that there must be material escalation to resolve it. Now, obviously, I have no geopolitical insight or kind of special kind of knowledge there what the US is going to do. But there doesn't seem to be an obvious resolution. And that needs to be resolved. If that is not resolved, we're going to get major asset price dislocations in the coming months. So even though material escalation perhaps this weekend would be negative in the short term and see dramatic headlines, that is actually the better outcome for risk assets. I'd be much more bearish if we are not getting the Strait resolved anytime soon.
Mark, can I just tie that back to your first answer on what we've seen in terms of the bond markets? If we start to hear more hawkish tone from central banks and action potentially, does that then put a cap on yields, particularly at the long end?
So that'll see front-end yields go higher again. It'll probably be more problematic for stocks just because we get a further kind of tightening at the front end. But ultimately, yes, we will see flattening. It'll get everyone kind of realizing, hey, we're going to have a growth impact here because the central banks are tightening financial conditions just as we're getting a stagflationary impulse. So we'll see a flattening of the curve. We'll see the long end come lower while front end goes higher. Either way, it wouldn't be great for stock markets, which is why I think the deterioration there is going to linger a bit longer.
OK, continued pressure, at least in the short term, across the global equity markets. Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's bring in Charlie Wells right now for your stocks to watch this Wednesday. Charlie.
Good morning, Tom. So let's start with Marks & Spencer because they had a profit beat this morning on their earnings report. And this has been a really striking story of a company really trying to recover from that devastating cyber attack we saw last year when really online sales were nearly impossible at Marks & Spencer. And once upon a time, M&S in the market was beating Sainsbury and Tesco. But you can see over time how that has transpired. M&S really struggling. Let's flip and take a look at some analysis coming from Bloomberg Intelligence talking about how Marks & Spencer has really tried to move from this recovery story to one of expansion. This earnings report could help, but what Charles Allen talks about here is that valuation still appears unconvinced that this time will be different. So does this earnings report help boost the stock, help move beyond this recovery story? Now let's flip and talk about Lanxess. So this is that German chemicals company. We know that chemicals had been in a difficult spot since the start of the Iran war conflict. We've actually seen a bit of a recovery in a lot of these chemicals. Now, Jefferies downgraded Lanxess, and this is important. Basically, analysts talking about how investors could be getting ahead of themselves. We've seen upstream spreads at a lot of these chemical companies actually improve since the start of that conflict, but we're seeing maybe a little bit too much excitement in the market. So a little bit of a warning there coming on Lanxess in that chemical space. Let's end on chips because this is one that everyone is going to be watching today. There's been a lot of excitement ahead of these Nvidia earnings, of course. We've seen traders get a little bit jumpy, right? So we've seen negativity. Semiconductor companies here in Europe had a bad day yesterday. If you think about the stocks in the United States, there was actually, a little bit of an improvement there, but a really jumpy day, sort of moving down and then up. How do traders start to respond here in Europe? I think that's a really interesting question as so much attention focuses on semiconductors today.
Charlie, absolutely. Thank you very much. Charlie Wells with those stocks and sectors to watch. And here's I'm pleased with this, here's a joined up thought. I try and average at least one a morning. CSG and Euronext both called higher this morning. And what I like about this is the Euronext boss was telling us earlier on that they will see a buoyant IPO market because of the defence companies that need to come to market because they want to consolidate. CSG is also called higher this morning, and that's in the defence space. And they're saying they're monitoring multiple acquisition targets. They're not called higher on that. They're called higher because they've stuck to their full-year guidance. But that seems to bring together a couple of the things that we've been talking about this morning around defence and IPOs and volume in the markets.
I'm impressed. Joined up thinking.
Can I leave now?
That's it, you're done.
Yeah.
Thank you, perfect. I'm going to try a joined up thought now as well. We've been talking about chip costs and memory prices. I wonder how that affects devices. We think about data centres, obviously, that is primary. But in terms of devices and electronics as well, there's a cost impact there. Google says it's going to be coming out potentially. They may announce some smart glasses. They've got a big event that's taking place, their annual iOS event taking place in the US right now. So there's a potential read across to EssilorLuxottica. So look at that stock because they have that partnership with Meta and they've been selling very well, those Meta glasses. So now there's a bit more competition. But will they be more pricey as those components around chips, which also go into
smart glasses? If we wear those on
glasses?
TV, do we have more joined up thoughts? Is that what happens? Makes us more intelligent?
I hope so. Not that I'm saying you guys aren't. I'm just saying I could do with the help. I'm going to wrap it up on a bow. Inflation seems to be the theme that's running through everything, though, this morning. We will factor that into our thinking as we get towards this European market open this morning. European futures are called lower, though. In the States, they are a more positive picture. But here at the moment, this is what we are looking at here. Let's call it down by 0.75%. We'll see what happens in just a moment. 5 minutes to go. We'll bring you that opening trade next. This is Bloomberg. Good morning, Wednesday morning. Let's talk about where we are with the markets right now as we head towards the open here in Europe. A couple of minutes to go until we start trading cash. This was the picture yesterday in the United States. The yellow line is where Europe went out. We then rallied in the United States, but then we faded into the close. And actually, I don't think there's really much, therefore, for Europe to price in. Nevertheless, actually, despite the fact that we ticked a little bit higher, European futures are pointing a little bit lower, Tom.
Currently pointing lower by 0.3%. Oil is lower, so we watch the energy stocks. We'll certainly watch the miners as well. Silver prices are up, at least in the session today. FTSE 100 futures pointing losses of around 45 points right now, pointing lower by 0.4%. Over in Germany, the DAX looking potentially to lose around 81 points, pointing lower by 0.3%. So yes, after 2 days of gains, a little bit more caution across the European equity space this morning, Anna.
Yeah, absolutely. Let's check in on some of the individual stocks that could be on the move then this morning. Charlie Wells giving us a bit of a heads up on some of these a little earlier. Let's start with Euronext. We spoke to the boss of Euronext, sounding pretty buoyant and bullish about the volumes going through right now in the trading business and the stock trading business. Interesting to see that investors seem to be impressed on the revenue side, but also on the cost side. So that's one that we'll be watching. Marks & Spencer, M&S also in focus as they continue to beat a path back to recovery after that cyber attack knocked them off course last year. So we'll watch to see what that does to the share price. They're expecting profits to bounce back to the growth seen before the attack. So that's of interest to investors. And also Lanxess, as Charlie was telling us, we are watching that one. Evonik, Brenntag upgraded, Lanxess downgraded at Jefferies. So that's an area of focus for the markets. The shares in Lanxess have rallied strongly. So we'll see what this one does this morning. Guy.
OK, let's talk about where we go with this market open, give you an idea of what is exactly happening. We're expecting a slight softening when it comes to European equities this morning at the get-go of trade. Let's show you some actual numbers. The FTSE 100 down by a touch, 0.1%. Basically, this is going to be the picture. I think it's kind of 0.2% across most of Europe this morning. The sector breakdown story could be quite interesting. It's taking a little while to get everything going. I've got the stock 600 down by 0.1%, the FTSE down by 0.1%. That's all I've got at the moment, to be honest. So I'm going to hand things over to Tom. What do you got?
Brilliant. Thanks, Guy. Yeah, top of the list right now, tech. That sector is performing relatively well. So far, up 0.4%. It's now moved. It's Basic Resources that's top of the list. Tech is still in positive territory, but right now it's Basic Resources up 0.8%. That's your top gainer right now across your sectors. Just 4 sectors in positive territory right now. Basic Resources, energy, utilities and tech. On the downside, the biggest losses coming through media. Interestingly, that sector's performed relatively well this week. Down 1.7% right now. So biggest losses for media, biggest gains right now for Basic Resources, currently up 0.9%. I mentioned the silver price. That is no doubt a factor, which is up about 2% on silver in the session today, Anna.
Yeah, just digging into the media sector and seeing what's on the move there. It's pretty broad, actually, so many of them in negative territory. ITV, WPP, Pearson, and I think there's an ex-div on 1 or 2 in that sector, so we'll leave that one. Gilts, let's have a look at where we are on the Gilts market then. We have, of course, got the inflation data out this morning, and we saw that came in a little lower than had been anticipated. We saw the labour market data a little weaker than expected yesterday. So all of that added up to a reassessment of how many hikes we'll get from the Bank of England. And traders duly took down their expectation of hikes this morning. And so that feeds into the gilt market with a drop at the 10-year horizon of around 6 basis points. So actually fairly sizable. We are seeing that is in keeping with the rest of Europe. That is the direction of travel we're seeing for the rest of the European market, bond market space. But a little bit more pronounced than the move we see elsewhere, Guy.
OK. Let's talk a little bit about what is happening as a result of all of this. Joining us now, Freddie Lake, Managing Partner over at Latitude Investment Management. I'll just be reading through some of the details of what you've got in the portfolio right now. How's it doing?
It's doing all right.
Yeah?
I think the main things is we didn't have any software earlier in the year, so avoided that.
That's a good thing.
Yeah, exactly.
Did
Don't have any tech hardware, so
Okay.
we've avoided that rally too.
Excellent. Well
but
done.
we're sort of carving through as our clients hopefully expect us to.
So what are you doing? Are you changing the portfolio? How are you adapting? We seem to be moving into a world of higher yields. How does that change your outlook on what happens here? Do you feel the need to get involved in the tech hardware story? Do you think that's got legs? How are you thinking about what you do next?
So we've made very few changes this year. We bought Kroger shares in the US, which is hardly the most exciting thing to talk about. But other than that, nothing done in the portfolio in 6 months. In terms of the tech hardware, no. I mean, the music's playing at the moment. The few people are spending extraordinary amounts of money. It might work, but I think the prices are pricing in a very, very positive outcome for those sort of
They're
companies.
trading on decent multiples, aren't they? Aren't they, some of these stocks looking like
Decent
the earnings are good?
Decent multiples of current earnings. Yeah. Earnings estimates being 2, 3, 4 times higher than they were a year and a half ago. And the point is, do you want to capitalise that level? Are they going to earn 2, 3, 4 times more money forever? In which case their share price as the discounted sum of cash flows should be 4 times higher. Or is this a demand cyclical build? And I'm firmly in that camp.
You're firmly in the camp that this is cyclical, it will roll over. And so you keep a more defensive portfolio. And part of that is reflects, you mentioned Kroger, so there are retailers in there, aren't there, Freddie? And let's talk about, you've got Tesco as well.
Yep.
And I wonder, with that in mind, your exposure to the UK grocery space, I wonder what you think about the fact that we've seen Rachel Reeves, the Treasury, consulting with the industry, talking about whether there might be the appetite to bring in voluntary caps on certain basic products.
Yeah.
What do we think about this?
Well, I can imagine how those consultations went. I think it's ludicrous. I don't think it's a workable policy. These companies make very, very thin margins. It's one of the most competitive sectors in our whole economy, and it is one of the most competitive grocery markets in the whole world. So prices are as low as they can be physically delivered. So if you try to cap the price of any goods within that space, you're going to have unintended consequences, whether that's on the farmers and producers and suppliers, or whether that's on other prices elsewhere.
So these are not high-margin businesses, as you point out, but the political realities mean that this is the path the government is sort of looking at.
Yeah.
Is it deliverable? Might supermarkets have to give ground on something else?
Well, I don't think it's workable because, if you make a sort of 3% margin as a system and many make less than that, how much of that can you eat into before I have to take the money from somewhere else or fire people or do something else which is going to have negative consequences? So I think it's the wrong fight to pick.
Are you worried about the consumer right now?
Broadly so, yes. Particularly in the US, where it's gone from quite bullish consumer down over the last 3 or 4 years, and that's been really notable, and not just in the bottom sort of quartile, say, but going into the middle consumers as well. It's really weakening the consumption around discretionary goods in the US. In the UK and Europe, it never really got that good, so it's still quite bad, but the delta hasn't been changing so much. But it's one of the reasons we prefer things like, staple retailers, grocery retailers, which would be a net beneficiary of consumption weakness because people eating out go back to grocery, people getting delivery go back to grocery, things like that.
There's a bit of a reprieve in the bond markets today. Gilts performing relatively well on the back of slightly softer inflation data. We'll see if that's short-lived or not. How close? When do higher yields become a problem for your equity holdings?
So we are very deliberately positioned in the more value end. Our portfolio is trading on 13.5 times earnings, and the less expensive your shares are, the less the share prices tend to be impacted by higher yields, just from a price perspective. Within the businesses, we buy very indebted by businesses, so they're not leveraged, so they don't have high interest payments in general. A couple do. And then we have some financial businesses that will be net beneficiaries of higher yields, like JP Morgan, things like that. So we think higher yields will actually be a positive overall for our portfolio, but we wait and see.
Despite the fact that you've got quite a lot in short-dated bond markets, it sounds like you're almost painting a sort of slightly deflationary picture. Is that what you're setting yourself up for here? Is you got lots of the portfolio in short at the front end of the curve?
Yeah.
Why?
The reason is, it's basically been a flat yield curve for quite a few years now.
Yep.
So you're not really getting paid any kind of premium to taking that duration risk.
Yep.
And when I look at the economy and think, what could be the next big issue? It is government debt. It is fiscal balances. It is, not being able to pay our bills. And when you pick on all the countries around the world who it might fall more on, I think the UK is quite squarely in the, high up that list. So taking on duration risk when the cause of the problem, as we've seen in the last few days, could be whipping higher bond yields, doesn't make any rational sense to me when you can get paid. I think we're getting 4.8 on average in our short-dated bonds. So,
is there a risk to the upside? Is there a risk that we get an inflationary surge and you get a crisis and that basically forces the Bank of England to hike?
Yes.
You're not positioned for that?
Well, if we were in the longer dated stuff, we'd lose money.
Even more, yeah.
Whereas we're in 6-month bonds.
Right.
So they won't move on a change in rates.
Okay.
They're very short dated.
It's
always cash-like.
Right. So that's almost cash. That's
exactly.
not a 2 year.
No, we're not really in that sort of stuff. We're very, very short.
And you're in US stocks quite a lot, not the tech names. So how are those performing when so much of the conversation is all around those big tech names? When you talked about Kroger, but what does the rest of the US portfolio look like, especially when you've got more big tech listings coming?
Yeah. I mean, if I'm honest, so far this year it's been relatively anemic. Some of the stocks are doing well. I mean, in terms of the businesses, the average of our portfolio is growing 15-16% a year over the last year through Q1 reported earnings. Estimates for the next few years look the same. So the operations of the business are exactly in line with the last 5 or 10 years. And we do expect share prices to perform in line with that over time. But everyone's ignoring it at the moment. I mean, the drumbeat of AI and hardware and chasing memory stocks and all the suppliers
and big listings coming, does that mean that everyone's even more distracted and the oxygen gets sucked out of all of those conversations that you're talking about now?
Yeah, in the short term, and I think while the music's playing, that might continue. But it can't continue forever. And we're starting to see signs of life in the portfolio even in the last couple of days.
Freddie, I want to ask about an idea that maybe seems pretty far-flung right now, which is that there is a resolution to Iran and that Strait of Hormuz reopens. How would you position for that scenario?
So we probably wouldn't make any changes around that either. We feel we're relatively sort of neutral to that. We do own Shell, so that's been a marginal beneficiary. But as you've probably talked about, the energy stocks have hardly rallied. I mean, it's up 25% this year. Oil's up 100%. So it's not expecting oil prices to stay higher.
And is that because there's a short-term benefit? Don't expect it to stay there. I was wondering if it's, there's a short-term benefit, but actually there's demand destruction perhaps lies at the other end of this.
It could be. I mean, the way I've read it, and who knows what the market's thinking, but is that, people are expecting higher oil prices for 3 to 6 months, but then it will fade. So it's a sort of one-off bump, which it will be to the P&L, but not something you capitalise. So unlike higher earnings in AI, where you're capitalising 3 or 4 times in your PEs, in energy they're not. But other than that, I don't think we have huge exposure, positively or negatively.
Come back to the portfolio structure. Effectively, a large chunk of your portfolio is in cash.
In the Horizon Fund, yeah.
Yeah, in the Horizon Fund. Is that deliberate? Are you waiting for an opportunity? Is this the Warren Buffett in you, waiting for something to happen?
I hope there's a little bit of Warren Buffett in me. No, that fund is for lower risk clients, so it's kind of always got half in non-equities.
Are you positioned more broadly, though? Are you waiting for an opportunity?
No, within equities, we're seeing extraordinary opportunity. Already, yeah, right now. So, we are very keenly writing to our clients, talking to them about the global fund, which is 100% invested in stocks, saying this feels like as opportune a time to be investing in these sorts of businesses as we've seen in the last 10 years. So I'm quite bullish on large swathes of the stock market and broadly the market in general. But I think the dominance of the tech hardware story, the size, the scale, and the overpricing, in my opinion, that's the risk to the market. But underneath it, it looks very healthy.
Okay. Nice to see you. Thanks for coming to see us. Always
Thank you.
appreciate it. Very late, managing partner at Latitude Investment Management. Let's take a quick look at the Core 6 and see what is happening there, just to get an idea of what is going on. As you can see, fairly mixed picture. Defence stocks on the front foot. Actually, ASML is having a fairly good day. Nestlé is a little softer. Keep an eye on Perrier and what's going on there. LVMH and Novo Nordisk, both softer as well. Let's deal with the details of what is happening. Charlie Wells is here.
Good morning, Guy. Let's kick it off with Marks & Spencer because they're in the green this morning, up some 2.5% this morning on the back of a strong earnings report with indication that they see growth ahead. Now, this was crucial for Marks & Spencer because they have spent the past year recovering from a devastating cyber attack, and they've really been trying to move from the story of recovery to one of growth. Now, analysts have been questioning this kind of flip in the narrative, but it's looking like the market, at least right now, is liking what it's seeing there. And this is really interesting too, because we've seen a number of UK and European consumer companies actually report stronger than expected numbers. And there's been a lot of concern about the economic uncertainty, a lot of this stemming from that conflict in the Middle East. But right now, a lot of these consumer companies looking strong and the market liking what it's seeing. But let's flip and take a look at an opposite narrative, because we have H&M down this morning, well over 1%. Now, again, this is a company that really has been struggling with margins. We saw some warnings from a number of analysts talking about the path for this company as they face intense competition. And again, that consumer story. So we're getting sort of conflicting stories from some of these consumer names that are performing well, and then others like H&M that are really struggling. So the market trying to kind of parse through some of these numbers. Euronext. Now, they had a strong earnings report. They beat expectations. Volatility has really helped this company. They also saw a boost from the Greek market and ETFs. And the market this morning liking what it's seeing here for Euronext, really getting that boost from volatility as we've seen so much trading, up 6.5%. Experian, let's bring that up too, because they met expectations. They had something of a mixed earnings report. Market not liking that, right? Down in the red this morning. Experian, now again, a challenge there for this company because of that earnings report. They even announced a $1 billion share buyback, but in the red this morning. Let's end on chips, right? This is the story of the day. We've seen so much interest here. We're in the green, right? They had a bad day yesterday, but we're starting positive here. ASML up, Infineon up, and a number of the other major players up. But let's see how the day unfolds, right? Because we saw a lot of volatility yesterday. We saw a dip and then an increase in some of the indices. So again, chips are going to be in focus throughout the day this morning ahead of Nvidia earnings.
Absolutely. Charlie Wells, thank you very much indeed on some of the individual stocks on the move this morning. Coming up, this is Guy Johnson's favourite story. Bloomberg understanding the UK Chancellor has privately proposed voluntary price freezes on some grocery prices. We'll have more on that story next. This is Bloomberg.
Welcome back to the opening trade. 17 minutes into Wednesday, the 20th of May's trading session. And European equity markets, yes, they're a little weaker, but not at all as weak as the futures picture had been suggesting. Maybe the FTSE 100 is, but that's down around 0.4%. But elsewhere, we see a pretty flat performance coming through on the CAC and the DAX, and the AEX boosted by tech. So that one is actually in positive territory. Quite a focus then, Guy, on things happening in the UK today.
Yeah, so the FTSE is underperforming. We're also watching what is happening in the gilt market. Today's inflation data, a little bit more benign, maybe the markets, or economists, I should probably say, were anticipating. And maybe that buys a little bit of time for the Bank of England to hold off. The two words you need to know about this morning's inflation effect are base effect. Sam Unstead is here, and he's all over that story. Good morning.
Good morning.
That's it, isn't it? Is this a reasonable reflection of the inflation picture in the UK?
I would say it's a reasonable reflection of where inflation was heading before the whole world was kind of upended by the war in the Middle East. So, so as you just mentioned, inflation a little bit lower than expected on the headline, almost all mechanical, almost all of it. So water bills going up by less than they did the year before, vehicle excise duty, there was a timing thing about package holidays, like all these different things have all come in and have, if you like, artificially pulled their headline rate a little bit lower. Without all of that, may well have been that inflation actually got back to the 2% target without the effects then of petrol prices going up, of sort of the overall effects of oil coming through, a little bit in food prices, a little bit in various parts of the report. But yeah, the main reason that it's gone down is all mechanical.
Do you think a cap on food prices will bring us back down to that 2% target? So the Chancellor has suggested this is potentially a voluntary solution and has been in conversation with the supermarkets about a potential voluntary price cap.
Yeah, so I think actually what making it or describing it as a voluntary price cap, that is effectively what already happens in the UK's grocery industry, because it's extremely competitive. Yeah. So if you live in this country and you see, say, adverts for Tesco or Aldi, most of those adverts are focused on we are matching the prices of our competitors. So very often when you get a little bit of a spike in food prices, there is an element of that that's capped anyway, because it's so competitive in the grocery market, and the companies within the sector want to get you through the door much more than that. They're willing to eat some margin to make sure customers keep coming through the door and then keep coming through the door for years to come. That likelihood is that this will have almost no effect at all on the actual inflation rate.
There's the politics. There's a lot of politics at play right now, isn't there? And maybe this camp competing with what could be other emergent camps to talk about the cost of living and the things they're trying to do to bring down the cost of living. What about within the retail space then, Sam? We've had numbers out from Marks and Spencer's. What's the story there? Which is part food, but obviously their numbers themselves are very heavily affected by the cyber attack that they had last year. So their profit fell almost entirely because of that. But food did very well. I would say for Marks and Spencer, who do enter this debate relatively often, but not quite so vociferously, the comments in there are very, very pointedly about pressures that they're facing from extra employment costs, extra taxes, regulation, and aiming that specifically at the government. So as we were kind of just mentioning, the atmosphere now between the retail sector and the government is getting more and more fraught.
Can you imagine a price cap on Percy Pigs?
Well,
that's what we're potentially talking about.
Well, that sounds good for consumers, doesn't it? But I'm not sure that Percy Pigs is supposed to be anybody's,
potentially very
basic
popular,
staple product.
They're clearly a staple if you go into M&S. You can't walk out of M&S without some Percy Pigs. Was that just me? I
think that,
there are alternatives.
No, I'm with you, Tom.
There are alternative Percy Pigs or pig-like
products.
Sweet products.
Simon Manstead, thank you very much indeed. Bloomberg Markets Today editor. Let's get back to another part of this inflation story, and that's what's happening with oil, of course. Right now, Brent is actually lower by 1%, but still around and just above that 110 per barrel level on Brent. This is traders weighing, of course, President Trump's latest threat to resume strikes on Iran. Joining us now is Jemana Pasechi, Bloomberg's Horizons Middle East and Africa anchor, of course. How seriously do you take the latest threats from President Trump? We've talked about the whipsaws. He's threatening again military action on Iran.
Yeah, well, it's customary for President Trump to make these types of threats. We've seen it many times throughout the course of this, by the way, almost 3 months war. It's been going on for almost 3 months now. Once again, yesterday, he said that they would strike Iran if they don't come to the table and agree to a peace deal. He was asked when that could happen. He said, well, we're giving them a window of 2 to 3 days. It could be Friday, Saturday, Sunday. I mean, the thing is, he's made these sort of threats before. He's given deadlines before and tends to extend them. So we can't take them perhaps too seriously or at his word. But I think what we can piece together from all of this is there has been a huge, once again, diplomatic push, not least by Gulf states, and he specifically referenced the fact that Saudi Arabia, Qatar and the UAE are pushing to get to a diplomatic solution. At the same time, the Vice President, J.D. Vance, also showing some more of a constructive tone and saying that military operations would only be their plan B. Plan A is still to somehow get to a negotiated framework. But, this comes back to what we've been discussing the last couple of days. They're still miles apart on some of those key issues, the main two being the Strait, obviously, which is still effectively shut, and the nuclear file. And that is not taking into consideration all of the other matters that hugely matter as well for the Gulf nations, including the proxies and the missiles and the drones that Iran are sitting on.
North Atlantic apparently does border the Gulf, because apparently NATO's talking about getting involved in...
I was wondering where you were going with that,
Why?
Yeah.
What is the remit here that gets NATO involved?
Yeah, so you're talking about the plan that we reported overnight that NATO are considering assisting with the passage of vessels through the Straits in July if there isn't a full reopening by then, a full unconditional reopening by then. Look, President Trump has criticized NATO many times for not doing more to help them. And remember, NATO obviously is a defensive alliance. They don't have a pretext to get involved in this militarily. But our latest reporting suggests that if the Strait is not fully open by July, then they would look to activate a plan to help get the vessels passing through. Now, the problem here is the mechanism. Clearly, the U.S. are trying with their own version of the blockade. They tried for a couple of days with Project Freedom. It's not so easy to get ships through the Strait because it is unsafe, it's dangerous, there may be mines there, and there's still the real possibility that these ships get attacked. So it is unclear what type of technical support NATO would provide. And then on top of that, according to our own reporting, it's not unanimous. There are many within NATO that have their reservations about getting involved as well. And ultimately, if they do go down this route, it wouldn't just have to be NATO. It would be a coalition of multinationals. So it would be, beyond UK, France. It would be probably Gulf allies and some Asian countries as well.
Yeah, I think it's really interesting the way that this conversation is evolving, the role that NATO is thinking of playing. And interesting in our story that they talk about how the longer this goes on, the duration of the conflict is perhaps changing that view at NATO and having them reassess.
This becomes a security risk for Europe. It becomes a risk towards the North Atlantic basin.
Yeah, and here in Europe, we're very cognizant of the fact that the conversation around NATO in the United States has developed in such a way that President Trump is expecting a lot, and he wants support, doesn't he? And he's been threatening and in some places actually actioning, removing troops. So we had a story recently that the Pentagon is cutting army brigades in Europe from 4 to 3. It's not clear what that does to the overall troop levels in Europe, but this is also obviously weighing into those at NATO and what they're thinking about. Right?
But as Boujnah says, it's meant, in theory, it's a defensive organisation. In theory, it doesn't have a global policeman role.
Correct. Yeah, and that was the reason to not get involved in the first place.
Yeah, precisely. Yeah. Trump has certainly changed it, but in terms of energy security, does that now get folded in to that narrative?
One thing to be mindful of as well, July, right? And all the energy analysts out there, including Jeff Curry, who was on Bloomberg TV yesterday, is saying that June is going to be crunch time for energy markets. So you keep an eye out on physical supplies there. If things really tighten, as all the analysts and experts are expecting, then maybe we have to see some action in July.
Boujnah, thank you very much. Boujnah Bhattachy bringing us up to date on everything that's developing in the Middle East. Coming up on the programme, we'll get back to the US economy as Kevin Warsh takes the helm of the Fed. We'll talk to Mark Giannone, who's chief US economist over at Barclays. What should we expect from the new regime? This is Bloomberg.
Welcome back to the opening trade. We are 30 minutes into the Wednesday session, and actually this is a slightly brighter picture than the futures had suggested. Yes, very modest gains of 0.1%, but as things stand, we could be set for 3 straight days of gains for European stocks. Very modest, of course, on the benchmark. You're seeing losses here in the UK. FTSE 100 down 0.2%. Media, so some of the big advertising names are under pressure today. The DAX is gaining just 12 points so far, and the CAC count adding 10 points as well. Basic resources, some strength coming through for that sector. The miners on the back of stronger silver prices. Guy, what do you see?
A market that's being pulled in 2 different directions, and to your point, that is effectively balancing out to a kind of a headline index level that is going nowhere in a hurry. So we've got 273 up, 304 down. Let's call that 1 for 1, reasonably balanced. Volume's actually a little light, which is interesting. Let's turn our attention to what is happening with the leaders this morning. What is interesting, actually, given all the turbulence around the chip sector this morning, is we do have ASML up. There you go, 2.55% is what we are seeing. Elsewhere, Euronext, we talked to Stéphane Boujnah a little bit earlier on, the volatility that we are seeing in global global equity markets at the moment, certainly feeding through very nicely into his business right now. That stock is up by nearly 7%. And Marks & Spencer on the back of its numbers as well on the UK high street, up by 2.14%, bouncing back from that big technical issue they had with the hack they had on their business. That's starting to maybe fade. Marks & Spencer up by 2% this morning. Downside, actually, a big focus there once again on the grocery sector. So we've gone from M&S to Tesco. It is down by 2.24%. We've already talked about what is happening in terms of the UK's view on what we could see with prices. Rachel Reeves talking about maybe fixing prices for groceries. That stock doesn't like that. Orkla's actually in a similar space. Its numbers don't look particularly good this morning. Up in the Nordics, down by 6.38, 6.4%. Similar story with Experian as well. Its numbers not being welcomed, down by 4.5. So there's a theme there between these three stocks as to what is happening with that narrative. Anna.
Let's get up to date with some of the other stories we're focused on this morning then, Guy. Chinese President Xi Jinping has warned against resuming military operations in the Middle East as he began talks with his Russian counterpart Vladimir Putin in Beijing today. The meeting between the two of the biggest backers of Iran comes a day after President Trump said he'd held off on a new bombardment of Iran at the request of Persian Gulf allies. Bloomberg has learned Goldman Sachs and Morgan Stanley have secured the lead positions for SpaceX's upcoming initial public offering. Billionaire Elon Musk's rocket, satellite and artificial intelligence firm is targeting a $2 trillion valuation. The listing is expected to raise up to $75 billion, making it potentially the largest IPO in history. And the European Union has agreed the text of its long-awaited trade deal with the US. Under the agreement, the EU will remove levies on US industrial goods in return for a 15% ceiling on tariffs. The European Parliament and EU countries will now vote to ratify the finished text. President Trump has threatened to hike tariffs on European cars if the deal is not in place by July 4th. Guy.
OK, let's turn attention to what is happening over at the Federal Reserve. Incoming Fed Chair Kevin Warsh taking office later this week under pressure, of course, from President Trump to cut interest rates. This comes just as we see a surge in inflation concerns, pushing bond yields, particularly in the kind of longer end space, to multi-year highs. Mark Giannone, Chief US Economist at Barclays, joining us around the table to discuss. Good morning.
Good morning, guys.
Is Warsh going to hike rates or cut rates?
I don't think he's going to do much in the near term.
OK.
I think
neither.
Neither in the near term. I mean, later next year, we anticipate the Fed is still going to cut. But clearly, market pricing has shifted now. Markets seem to be expecting now a rate hike from the Fed.
If the market continues to push and price in that hike, will the Federal Reserve have any choice but to follow the market's lead, do you think?
I don't think so. I think the Fed is going to be looking really at the macro factors. It's going to look at the inflation picture, at overall economic activity, and it's going to make a decision based on that.
So not behind the curve?
Not, well, you know, I think they're going to look through that oil price shock, we think.
What assumptions are you making about how long the oil pressure continues, how long the Straits of Hormuz continues to be closed, with that forecast that you still get a cut next year from the Fed?
Right. No, it's a great question because the WTI futures, for instance, or Brent futures show a pretty rapid decline in crude oil prices. We take the assumption that oil prices are going to stay slightly more elevated through the rest of this year. Actually, we follow our energy analyst forecast that thinks that Brent may end the year at around $100, with WTI slightly lower than that, and then gradually come down. So with this somewhat more extended price shock, if you want, or oil price shock, we think there's going to be some pass-through to core prices.
OK, so some pass-through to core prices. There's an expectation, there seems to be a factor in terms of the bond sell-off that's saying that there's going to be additional spending coming through, not just from the US, but other nations as well. But predominantly, of course, they're going to have to fund the war. Defence spending is going to go up, and other commitments from the US as they continue to absorb, of course, that tax bill that was put through. How concerned should we be about the US deficit, about how much borrowing is being pushed through by this US government right now? To what extent is that top of mind for you as we think about the pressure at the long end?
Oh, that's very much top of mind. And I think we get to see this reflected now in bond yields. Now, the thing is, the fiscal outlook looked better a few months ago, right? With tariffs bringing in a lot of revenues, with no expectations of really rapid increase in defense spending. And now, with the war starting, the tariff revenue, some of the tariff revenue declared illegal, which means that the outlook for revenues on that front are going to be lower, and on the spending side, likely higher. So we expect deficits to actually increase substantially. We're not sure that this is going to provide a big fiscal stimulus, though, because offsetting that, we are going to have, we expect, like a significant slowing in consumer spending towards the second half of this year. In particular, with income having slowed for households pretty significantly over the past year, and then also the oil price shock that we are seeing now that forces households to cut back on other spending.
Okay, so that's where this becomes about growth then, and not just about the inflation dynamic, Mark.
Yeah, I think the Fed is very much balancing the two things. So now they are facing a very difficult shock, right? Inflation is moving to the upside. On growth, I think the prospect for that are that we are going to see some slowing on the consumer spending side later this year. And so the Fed has to balance these two things.
Yeah.
What they don't want is the inflation shock to translate into second and third round effects on the core.
So you see the consumer weakening for the reasons you've described, but inflation could go higher, is being driven higher by the oil dynamics. Is it also being driven by the AI capex build out? What is the effect of that on the US economy?
Absolutely. We've seen AI capex last year in 2025 boosted GDP growth by about, or at least aggregate spending by about 80 basis points. So out of the 2% growth that we saw last year, 0.8 percentage point of that came from spending on AI-related activity, right? In data center to some extent, but more importantly, software, computers and equipment and peripherals. We expect some similar contribution this year in 2026. So very strong boost coming from that. And that also raises the stock market and provides some wealth to consumers.
The overall AI effect on the US economy is a separate conversation perhaps, but one that Kevin Warsh has shown some enthusiasm for, but he thinks it's deflationary. Is this just a timescale question?
I think
Does it become deflationary? Does it become deflationary in the time horizons that you're expecting rate cuts?
We don't think so. We think, to your point, this is it's really the time scale that's important, right? So in the near term, we see a very strong demand here in investment, in boosting activity overall related to the buildup, and also bottlenecks building up, right? We see a lot of prices moving up in that relates to chips and memory and so on. So that's also affecting the consumer to some extent. So the disinflationary part is going to be later on, when the productivity improvement that everybody seems to be expecting are finally realized, so that we can actually produce at lower cost. This is going to be down, several years from now, we would expect.
Okay, so it's jam much later tomorrow. Can I just talk about kind of where we are now? Nominal growth this year, strong in the United States.
Yeah.
How real is that growth? You've got a deficit that is epic by kind of historical standards. You've got an AI build-out that is substantial. If those two effects start to fade, where does it leave the US economy?
So I think that's the key point, is that consumers, we think, are the ones that are driving the economy for the most part, right? That consumer spending represents 70% of aggregate spending. So far, the consumer have been in great shape. They've earned a lot of income in recent years. They've seen asset value go up a lot, so they've been spending a lot. Now we think that with the price increase and with aggregate income actually slowing, they will have to slow their consumer spending. So we are looking at like 1% growth in consumer spending in the second half of this year on an annualized basis, maybe leveling off later on at around 1.5% growth, but no longer the 3%, 4% growth that we've seen in recent years.
Yeah, that's quite a markdown, isn't it? 3 to 4% to 1% in terms of consumer growth, consumption growth. The jobs market was looking quite perilous. It maybe perilous is a stretch, but it was concerning people towards the end of last year, and then the data seems to have suggested there's a bit more resilience in the jobs market of the US than maybe we had feared at the end of last year. How confident are you that the US jobs market holds up through the rest of 2026? What is the labour market looking like right now for you?
Right, the labour market is really interesting in the US. So we've seen, in recent years we saw like very strong job gains, right? That in 22, something like 500,000 job gains a month, then moving down towards like 300,000 job gains a month and so on. Over the past 3 months or so, we've seen only 50,000 job gains a month. So we think this is the result of two factors taking place. One is businesses are cutting back are no longer growing their jobs at the same pace as before. The hiring rate has come down substantially over the past year. Businesses are basically going, the demand for workers is actually quite a bit softer than what we've seen in the past. But simultaneously, what we've seen is a very significant slowdown in the supply of labor. So workers coming from abroad, of course, immigration has been cut back very, very significantly. And at the same time, we are now at a phase where people are retiring in much greater numbers. So the domestic labor force participation is actually coming down as workers are exiting the labor market. So as a result, what we see is a much slower pace of job gains, month after month after month, but not really an increase in the unemployment rate. If anything, the unemployment rate is stabilizing, maybe drifting down. We expect actually the unemployment rate to continue to drift down this year, even though the pace of job gains would be at around, let's say, 50,000 jobs a month, and then drifting down to about 25 and closer to zero later on.
And so, I mean, is the AI effect, is that there? Is that in the numbers yet? I take on board the fact that you said you expect the unemployment rate to go downwards, but in terms of those jobs that are going, or the reduced demand for labour, is that an AI effect, or is it too early for that as well?
No, I think so far the AI, if anything, is helping on the demand for labor, right? In the build-up.
To build the data centers.
Exactly. So I think this is, for now, it's still a positive. I mean, the negative, we're not so convinced. I mean, I know there's a big narrative out there that eventually all the jobs are going to disappear because of AI. We are somewhat skeptical about that. We haven't seen this in the past, right? With the technological revolution that are sort of general-purpose technologies that would lead to an aggregate reduction in employment. We haven't seen this in the past. This time could be different, but this is like far down the future.
Yeah, it's your world of banking that's causing some concern.
Yes, lower value human
capital from one of your competitors. Mark, thank you very much indeed. Mark Giannone, Chief US Economist at Barclays there with a deep dive view and analysis, of course, on the current health of the US economy. And tying into that US economy, of course, is the AI story, as Mark was saying. Part of that will come down to Nvidia, and those earnings are coming up, of course, after the market today. We're going to talk to Claire Pleydell-Bouverie, fund manager at Liontrust, as the world's most valuable company reports. After the bell, Nvidia earnings in focus. Analysis next. This is Bloomberg.
Welcome back to the opening trade. 8:46 here in London, and we do have it all looks red, but it's not red by very much. We're down by 0.1%, if that, on these major markets, so not really very into negative territory. US futures are actually pointing higher a little. It is a handover of negativity from Asia that we perhaps have in mind, and that was tech related. But actually, the tech sector is actually doing well in Europe today. It's up by 0.7%. So, Tom, we don't have necessarily that read across from the drama in the Kospi into the European session.
That's the drama has faded, hasn't it? At least for now. Let's think about what else we are watching throughout the day. Then the nominee for Bank of France Governor Emmanuel Moulin appears before the National Assembly at 10 a.m. UK time. Some lines have been dropping from him already. Italian Prime Minister Giorgia Meloni meets her Indian counterpart Narendra Modi in Rome, and Russia's President Vladimir Putin is in Beijing. And at 7 p.m. UK time, we get the Fed minutes. 9:20 p.m. UK time, Nvidia results. Let's take a closer look at what to expect from those Nvidia earnings then, and bring in Claire Pleydell-Bouverie, fund manager at Liontrust, joining us now. And of course, Nvidia sits in your funds. Claire, good morning. Thank you for joining us. So, as an owner of Nvidia, what are you going to be scrutinising from the earnings?
Probably the most important forward-looking indicator for us are purchase commitments, because this doubled quarter on quarter in the last print. We went from 50 billion in Q3 to 90 billion last quarter. And this is essentially Nvidia locking out the supply chain. It's no surprise to all of us that the supply chain is very tight. We all hear about there not being enough memory to go around. TSMC silicon is a meaningful bottleneck. Optics is the same. Well, Nvidia have got between 2/3 and 3/4 of the supply of these key components through 2026 and into 2027. So we're expecting a significant step up again.
So to be clear, this is Nvidia's purchase commitments for its suppliers, or purchase commitments from hyperscalers for Nvidia chips?
Purchase commitments to suppliers,
to
precisely.
suppliers. Okay, so that for you is an indication that they have continued control over that supply chain.
Absolutely, because the risk going into this print and really throughout this year, we think, is not about demand. We do not think that that is a risk anymore. This is solely a question about supply. 6 months ago, the market was focused on, are we overbuilding? The biggest risk now is, can we build fast enough to keep these earnings moving in line with the stock prices of the entire ecosystem?
Is Nvidia the way to play that, though? Or are some of the Asian memory suppliers the way to play it? Are they a cleaner, more monetizable kind of short-term play on how this AI build-out story is going to develop? Have we moved on from Nvidia to those kinds of companies?
Well, that's exactly what the market has done over the past 6 months. You look at the stock prices of SK Hynix, Micron versus Nvidia. Right now, we see more...
Is that the correct move?
Possibly in the short term. I mean, what the market has done, and we've all spent a lot of time doing, is following the bottlenecks. And over the past 6 months, those have been particularly in high bandwidth memory. Optics has been a key one emerging. But right now, the first derivative of the AI trade is now offering the most compelling valuation. And what we saw last quarter with Nvidia, and we're expecting to see continue throughout 2026, is a re-acceleration in their top line and on their bottom line. So Nvidia grew earnings about 50% last year, year on year. A very admirable achievement for a company of that scale. That's set to grow almost 100% this year. So right now, we will be trimming some of those Asian component suppliers because, yes, they are pure plays on some of these bottlenecks, but their stock prices also moved an incredible amount in the past couple of months.
Can I ask you about the life of some of the products that Nvidia puts into these hyperscaler businesses and others? Because the life of them and the period over which you depreciate them was something of a topic of conversation for quite a while. And you've got some interesting stuff in your notes about how the installed base becomes more valuable, not less. Explain how that can be possible.
Absolutely. We do think that there has been a misunderstanding about this because with NVIDIA architectures, they've now got a 1-year release cadence, and you buy the latest and greatest for training your large language model at the frontier. So that's Blackwell Ultra right now, moving to Rubin next year. What happens to Hopper, which was the prior architecture, even Ampere, which was 6-7 years ago, is that those N-1, N-2 architectures move to inference. And inference is when customers actually monetize these assets. So the ROI on these architectures, they actually go up, not down. And what we've seen right now, because we're in such an acutely demand-supply constrained imbalance, is that the prices for Hopper, they've gone up 35% year to date in the cloud.
Yes.
And the reason these get so more valuable over time is because they're optimized by software.
Yes.
And that's the whole CUDA ecosystem mode.
And one of the reasons why the market's attention switched to Asia was because of the memory story. We've also seen a lot of businesses trying to follow Nvidia and trying to grab some of that market share, and some of them arguably trying to, managing to deliver higher profits as a result. But does Nvidia need to worry about that competition or not at all?
Competition from
others who are trying to do what Nvidia does?
Well, it comes down to locking out the supply, and so these.
It's not about Rubin and what it can do versus the competition.
Well, Rubin is definitely a massive leap forward versus competition, and what we saw from Google with the TPU last year, TPU version 7. This is very competitive with Blackwell. That does change with Rubin. Google moves to its next TPU architecture, and Rubin particularly moves to a more memory bandwidth intensive architecture, which is really, really crucial for inference. It's got about 2.4 times more memory bandwidth. And that's really, really important as we move into the agential era, which is highly more compute intensive.
Yeah.
It still does come down to capacity at TSMC and capacity with these memory players. And these ASICs players just do not have that same weight.
Everything costs a lot in this industry at the moment, and you're making that point very clearly. Are we as users, are corporates as users, paying the correct price for the AI that they are consuming at the moment? And if they did, would they use the same amount or would they use less? Are we being subsidized at the moment by the industry, and you look at the cash flow story for what we're using, and does that need to change?
So we expect the cost of AI to continue declining. I mean, the cost of inference right now, it's about 1,000 times cheaper than it was last year.
Right.
And you achieve this through technological progress. Every time NVIDIA moves to a new architecture, this brings down cost per dollar, cost per
The companies are still burning money.
The companies are burning money, but that's only because they're continuing to invest. I mean, the hyperscaler capex, if we look at this, is slated to be over 700 billion this year.
Yep.
If there's a sort of 12 to 24 month hiatus between standing up this infrastructure and then actually producing revenues from it.
Yeah.
Andy Jassy sort of painted this clearly in his shareholder letter last quarter. And because the hyperscalers are seeing ROI on the capacity laid 2-3 years ago, they're continuing to invest, but more than what the revenues are. So we think the right metric to be looking at is revenue inflection, cloud revenue inflection, not free cash flow.
Okay.
We're expecting free cash flow to actually be materially negative for all the hyperscaler players next year. But the crucial point is that revenues are now inflecting. We saw this from Google, 63% year on year.
Claire, thank you very much. Claire Pleydell-Bouverie joining us from Lion Trust. Let's get a broader take on the markets. From the Markets Live team, Adam Linton joins us on set. So, Adam, the focus of your day, is it Nvidia or something else?
Well, it's definitely avoiding anything to do with Arsenal, but yeah, obviously, Nvidia is absolutely key. I mean,
meet Tom.
Exactly.
I don't know where he ditched the scar.
One little celebratory lap, surely, of the studio.
Oh, no, I mean, Instagram is not getting open today. It's been absolute turmoil. But in terms of what I'm watching, of course, Nvidia is the big one. I mean, it's essentially a macro data point at this point. And when you consider how narrow the leadership and the rally has been since late March, and tech's been at the centre of that, and Nvidia accounts for like 75% of AI infrastructure, then of course it's important. I think, if you park aside yields for the moment, the problem is the backdrop for Nvidia earnings is always just so difficult. I mean, we're expecting to see another kind of beat and raise quarter from Nvidia, but the problem is that we've seen that for the last 4 quarters, and the market reaction has been getting increasingly negative. And Nvidia last quarter, I think they're down 5.5%. The day after earnings last time, and when Nvidia goes, the US stock market will go. And so that's obviously a cause for concern, particularly in the current environment where people are questioning the impact of high yields. What does this mean for equities? So if you do get Nvidia coming in a little bit soft, yes, I know your price earnings multiple is a little bit lower than previously, then this could potentially be a little bit of an inflection point for the market.
OK, Adam, thank you very much indeed. Bloomberg M-Line strategist Adam Linton with that look ahead to Nvidia. European stocks currently across the benchmark a little softer by 0.2%, but you are seeing some reprieve in terms of the bond markets, at least for now.
I'm going to check in with Adam, make sure he's really OK. Sounds like he's had a tough day. European equity markets then on the back foot, but not by much. US futures flat to positive, in fact. So Nasdaq futures up 0.4%. That is it for the opening trade. The Pulse is next. Have a good day, everybody. This is Bloomberg.